You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined today by our special guest, Leandro, or you might know him better by his Twitter, which is Invesquotes. Firstly, thank you for coming on the show. And do you want to just talk us through, in your own words, your investing career to date?
Yes, of course. Thanks for having me, Sam. My investing career is not that long. It's, I would say, 5 years, more or less. I started reading Peter Lynch and, well, things about Warren Buffett. So that got me interested in investing. I studied economics and I loved my finance subjects. So I was like also very, very keen on knowing more about the investment world. So I don't know how to say it, but as I read, I knew that investing was very, very difficult. So I decided to just dollar cost average an index fund, which I have been doing like almost up to now. I started individual stock investing more or less 1 year ago, and that's my journey. And then I started also researching companies, and I love investing not just because you can make money, but also because you can learn a lot of new stuff.
So could you talk a bit about the newsletter and how that started? And also, because the newsletter's recently changed, hasn't it? So maybe it's worth talking a bit about that as well.
To invest in individual stocks, individual companies, I already researched them, but I didn't write it down or lay it down. So I decided to start doing that for myself, because I thought that writing things down, well, would help me like clear my thoughts. Then I decided to start publishing these researches as Twitter threads. And then I don't know if you know the account Route to FI. He has like, I don't know, 50K followers on Twitter. He told me like, hey, why don't you open a Substack and start doing this? So then I did it, and I started with Pinterest, that I was going to do a Twitter thread, but I changed it to an article, and that's how I started. And now the newsletter has changed because, well, I asked Buy and Hold on Twitter that he to collaborate in the newsletter, because I was focused on US companies, and I wanted to open the scope of the newsletter to Chinese companies in the case of Buy and Hold, or emerging markets. And hopefully in the future we will bring more content from other geographies such as Europe or, well, UK, Nordics, etc.
And how did the potential multi-baggers come about? How did Chris end up reaching out to you?
Well, since the start of my Twitter journey, I talked to Chris because he was one of the first accounts that I followed, and I liked his content and his service, which I was subscribed to. Well, I'm still obviously. And then I always asked Chris for his feedback on my research, so he could help me out. And well, he asked me one day to collaborate with him in his service, and to be honest, I couldn't believe it. But I started doing it, and I saw that my process improved a lot, because when you are going to put your content in front of more people, it's like you research things 2 or 3 times to make sure that they are right. It's not like if you're researching it just for you.
Could you talk about your investment appraisal process and how you'd go about looking at a new stock or potential investment?
Yes, of course. I follow a top-down approach, in that I first look for industries that I think will enjoy secular tailwinds. And then I try to find the company that I think that is going to be a winner inside that industry. To give you a recent example, now we are researching at the Global Investor newsletter, Farfetched, that is, a company in the luxury industry. We decided to research Farfetch because we thought that the luxury industry was going to enjoy secular tailwinds because the middle class is increasing, and increasing the middle class towards a more high medium class is very well. It's going to benefit luxury, especially e-commerce luxury. So we decided to go with Farfetch. This doesn't mean that we think that Farfetch is the winner, but we have to start somewhere. It was the same way exactly as with Unity. I wanted to have exposure to the gaming industry, and I decided to research Unity. And when I saw that the company was not only a gaming play, well, I decided to invest. But that's how I follow it. I go from the industry to the individual company.
What are the best books that you've read on the subject of investing, and how much do you read in general?
Well, I think the book that has shaped me the most as an investor is Phil Fisher's Common Stocks and Uncommon Profit. And I also enjoyed Peter Lynch's books, especially One Up on Wall Street. I think, well, these two investors know how to add a lot of value in a language that everyone can understand. And I think that's very difficult. Especially, I have realized that this is very difficult since I have started writing. And about the time that I spend reading, I'm gonna be honest. Before the newsletter, I read a lot of books. Like, I was continuously reading books. But after starting the newsletter, I mostly read articles, company specific or investment related in general. But I have stopped reading as many books as before. It's something that I want to change, obviously.
So what are the best resources that you use for investing? And they can be free or paid.
Okay, so to do my research, I mostly use company feelings, which obviously are free, because I like company feelings. I see that many people don't like them that much, but I think it's where the information is. Like, the information is neutral, and this is very important, because if I'm starting my research reading a very bullish article, I'm probably gonna be biased for the whole research. Whereas if I start reading a company feeling, I'm probably not going to be biased, because they have to lay out, for example, in the 10K, all of the risks, even the ones that seem stupid, but everything has to be laid out. Then I also subscribe to Chris's Potential Multibaggers on Seeking Alpha, and I'm also subscribed to Connor's Substack. Well, I think they provide great content, and I don't have, all of my holdings are not in common with them, but I don't care. I can read, for example, an article from Chris on C Limited, which I don't hold, and I enjoy it and I learn with it. And I can, read Connor's articles on Kura Sushi, and I also enjoy it. Then, to find info about the stock, I normally use Y charts, Yahoo Finance, and also Coifin charts. And then for example, topics such as insider trading, I use Open Insider. And for things like ownership, I normally use Simply Wall Street. And those are mostly the sources I use to do all my research, because mostly everything you need to know is in the company feelings, and it's how you interpret them is what you get from the research.
Who do you look up to as an investor?
If we are talking about well-known investors, I think it's Phil Fisher and Peter Lynch. And on the not so globally known front, I really like Chris's from Potential Multibaggers extensive research. I think he not only has a research service, he has built a community, which I think is very important, because it's, for example, one of the great characteristics of FinTwit, that you can engage with other people that might be more experienced than you in certain topics. So I would say those three.
Which Twitter accounts would you recommend following the most?
Okay, I think that if I have to say here all the accounts that I recommend follow, I think we're gonna be here 3 hours. So I would recommend mostly all of the accounts that I follow because I follow them for a reason. I wouldn't follow any account if I don't consider that they are adding value. In fact, I unfollowed several accounts which I thought that were not adding like value to my feed. If I have to point out a few, I would say, well, From Value, that is Chris, Clueless. I don't know if you know that account, but he's a really intelligent guy. He's a software engineer. Mark, Jessica, Buy and Hold, of course. Well, and there are many more. Like I could be here 2 hours.
It's probably worth shouting out your Twitter again then. So your Twitter account is at Invesquotes, so INVESQUOTES. So if anyone does want to go and have a look at all the rest, you can just head to his Twitter account and go down the follow list. So what do you know now that you wish you'd known when you started investing, and what advice would you give to yourself when you were just starting out?
Okay, I think that when I started investing, I wish I learned to never compromise my quality standards from the start. What I want to say with this is that many times you will study a company and you are going to like lots of companies. But liking a company is not the sole reason for investing in it. For example, if I want to have a goal of holding 12 companies in my portfolio because it is something that I think that I can keep up with, if I like a company, but I don't like it more than the 12 I hold, I need to learn to, well, I wish I knew before because now it's what I do, but I'm not going to add a 13th position just because I like the company. I'm going to ask myself the question of, does this company beat any of the 12 companies that I already hold? And if the answer is no, it's a pass, even if the company seems good, because, well, you are also an investor, so you clearly know that there are many opportunities out there and many ways to make money in the market, but you basically can't hold everything because one, it doesn't make much sense, and two, it's impossible to hold high conviction on 70 companies. Also to scale in very slowly, because sometimes you'll look at a chart, for example, and you see, okay, this company is 50% of highs. And you say, oh, it's a perfect moment to go in. I like the company. I think it's very good. So if it was at 100 before and now it's at 50, surely it's a steal. I'll buy a full position right now. That has played out to be a very bad decision. So I'm now I scale in very slowly to my position.
So how did you come up with your limit of 12 stocks in your portfolio? What was the thinking behind that?
Well, it was quite easy. I had 20 positions. This is excluding the ETFs, only individual companies, and I couldn't keep up with it. I could keep up with several companies, but not with the 20. So I felt like I was lagging behind the info that was being released by some of my holdings. So then I decided to bring it down. Like the limit is not 12, but it's between 12 and 15 maximum. I know that more than 15 I cannot hold because I cannot keep up with it, especially because I have a 9-5 and I don't work full time on investing. If I worked full time, this number could vary, obviously.
How have you evolved as an investor?
Well, I have always been more a fundamental investor than technical, but I have evolved into a kind of hybrid investor because now I like to incorporate to my decision making some kind of technical analysis, although very basic, like I don't know, the moving averages. I don't get too obsessed with charts, but as much as I first thought that charts were useless, I think that charts can also give you information not to see if a company is a worthwhile investment, but to maybe find a better entry point or to be cautious. These like technicals obviously have some limitations. I don't know if it was Cloudflare that hasn't touched the 200-day moving average since IPO. So imagine, like, I would be quite upset if I didn't hold it just because I was waiting for it to come back to the 200 moving average.
Is there, so actually this, I think you're the first person that we've had on the show that's ever mentioned technical analysis. Me and John might have spoken about it on normal episodes, and I doubt we'd have spoken very positively. So if someone did want to learn more about technical analysis, where would you recommend they go?
Well, I think there are several accounts on FinTwit that are very good on technical analysis. I normally talk a lot to Markets and Mayhem. That is an account on FinTwit, because he knows like how to read the charts. But as I told you, my technical analysis is very, like, knowledge is very poor. But I try to incorporate it, because I think that if you can balance both fundamentals and technicals, you can improve your results. Although I obviously will overweight always fundamentals.
What are the biggest mistakes that you've made in investing?
Well, this question, I think it's quite simple, because I think it's common with everyone. I have shared some of these mistakes on my Twitter account. Well, today we released an article of the Global Investor newsletter that, well, was centered around that it's okay being wrong in investing. But I would say that I have made two main mistakes: not buying or selling stocks because I thought they were too high. For example, I didn't buy Alphabet in when it was in the 1900s, because I thought it was too high. And now, well, it has run up quite a bit. I sold Shopify in the thousands, thinking it was also too high. And well, each of these mistakes have cost me 50% each, because Alphabet both have run up 50%. And then the other mistake is buying stocks or not selling them when I was already holding them, because I thought they were trading too low. But surprise, they can go lower, even if it doesn't seem like they can go lower. I made this mistake, for example, with Banco Santander, because the stock was depressed post-COVID. And I said, no, it's too low. Surely it's going to go back to new highs. Well, obviously, I ended up selling it at a 40% loss, because I wasn't even comfortable holding it, even if it was very, very cheap.
What are your thoughts on current valuations in the US?
I think that in every market and in every period, there are some overvalued industries and some undervalued industries, and some that may be fairly valued, and we will only know with the benefit of hindsight. I think that COVID has drastically changed tech adoption, and this is why many work from home and tech companies have run up so quick. And people think that many investors think that tech stocks are really ahead of their fundamentals, but COVID is, well, more or less a thing of the past, because the vaccine was rolled out and they are still delivering strong results. I don't look too much at valuation, for example, when analyzing potential upside, but I do like to look at it when analyzing downside, because, for example, if you buy, say, Cloudflare now, that it's one of the most richly valued companies, tech companies. If Cloudflare is the winner of the edge computing industry and cloud, in 10 years' time, you're going to look back at this price and think that it was a steal at current prices. But if Cloudflare is not the winner, well, a lot has been priced into the stock. So you're gonna probably face quite a bit of losses. So I think that there are pockets that are overvalued and pockets that are undervalued, and some are fairly valued, but I don't think I'm capable enough of saying, well, this is overvalued or this is way undervalued, because Amazon probably went through periods of a lot of overvaluation, but at the end it was a worthwhile investment. And I know Amazon is not the perfect example because it's an outlier, but you get the point.
Do you look at any UK listed stocks at all?
I don't, and this is one of the things that we want to change in the Global Investor newsletter, because I think that FinTwit is like a bubble, in that it's too centered around several companies, especially US companies. And we want to start researching companies in other geographies, and UK is obviously going to be one of the markets that we are going to research, because there are great investments in other parts of the world.
Yeah, I do agree with what you've said about FinTwit there, because I think one thing that's talked about a lot is it's called home bias, isn't it? Where a lot of investors, they're more likely to invest in their home market. And I know FinTwit has a lot of Americans on anyway, but it seems there's a lot of the foreign or non-US accounts on there that are almost entirely US based in terms of what they invest in. And it's almost like the opposite of home bias, where they just, even though they know, so there'll be some people where they're in other countries, and I think they must be able to assess some of those stocks quite well because they're familiar with the businesses, but they don't look at them just because, like you say, I think some people are in the FinTwit bubble, where because everyone else is talking about US, I think they might not realize they've got some very good companies on their own doorstep. So speaking of your own doorstep, then, do you look at stocks that are listed in Spain much?
I don't, but this is for a very simple reason. Spain is not built as the US, for example. If you're an entrepreneur in Spain, you're going to find that doing business is quite complicated. It's not as easy and in the US that you can get started and failure is seen as something positive to continue your career. In Spain, there's a lot of fear to fail, and there are many hurdles to start a company and to be an entrepreneur, and there's no incentive to creating tech companies in Spain. So if I join this, that it's obviously a consequence of the political landscape that we've had here for the last, 20 years, where we don't really have politicians that are worried about where the economy is going. So I don't invest for that reason. And if you see the Spanish stock market is very weighted towards mega caps legacy companies. So here there's like little disruption. And then I obviously like to invest in companies that disrupt others. And here it's difficult to do that.
I think that might be more of a Europe-wide thing than just Spain, because I think it's quite similar in the UK. I mean, if you look down the list of stocks on the FTSE, say FTSE 350, which is the biggest 350 companies in the UK, there's some very, very good stocks in there. But like one thing that jumps out is there's nowhere near as much tech as you'd see on the S&P 500, for example.
Yes, I totally agree. Like here in Spain, you have a lot of banks, but banks, the legacy banks. You have construction companies, physical retailers. That's like most of the mega caps here are those, and I don't like that at all, because I think that they are following business models that are easy to disrupt if you have a good tech competitor.
I think a good example here in the UK is it's something that I talked about with Connor at Casio Capital. But obviously in the US, in like the housing market, you've got Zillow, you've got Redfin, I think Open Door is one of the other ones. If you look at the UK, we've got Rightmove, And Rightmove is very different in that Rightmove just works with the existing agents, and it almost provides this platform for people to go and look at properties, and then it just charges fees to the agents. It doesn't really disrupt the market in the same way that, for example, Redfin's trying to do. And there's not really a company I'm aware of that's of a decent size in the UK that's actually doing that. So that's quite a good example. And that Rightmove would probably count as one of our tech companies in the UK. But then if you look at how disruptive it is compared to its US equivalent, it's definitely not as disruptive.
No, I completely agree. In the US, they have done a tremendous job in preparing the country to lead the tech revolution. And another example is Israel. They have invested a lot of money into tech and into the development of tech, and now they are seeing the results. But I don't want to think in 15, 20 years what results they are going to see compared to what we're going to see in Europe.
How do you think about your position sizes and allocations then?
Okay, so, well, how I said before, I try to hold a number of companies that I am able to track. I don't necessarily track them on a daily basis, but I should be able to track them on a quarterly basis when they put the quarterly results out. And so this is, as I said, it's not a fixed number. It can vary, but more or less around 12 and 15. And then for position sizing, I don't have specific rules like, hey, a position cannot go more. Well, I like to be diversified. I wouldn't hold 90% on one company, for example, because even if it looks like a very safe investment, I can make a research mistake, and I don't want to put 90% of my worth or my net worth in that mistake. I just try to mirror my portfolio on a cost basis with my conviction. So once in a while, I'll get my portfolio, see the cost basis of the portfolio, and then I'll see the order from largest to smallest, and I'll say, okay, is this the order I want to have? Or maybe I'll put an example that it's not a real example, it's an invented one. Imagine that Teladoc was my 10th position on a cost basis. But I think that Teladoc is going to have a great future. And for me, it should be like it's top 3 conviction in my portfolio. Well, obviously, I know that I have to increase the allocation to Teladoc to increase it on a cost basis, because I want, if my portfolio doesn't mirror my conviction, I know that I'm going to end up doing fatal mistakes. And the percentage that I allocate, well, I have Amazon right now, it's like 16% or 18%. And then the next one, I don't know if it's 8% or 7%. So I hold, it's quite equally weighted, but it's obviously overweight to those that I have more conviction in. But the difference between having high conviction and lower conviction is not, for example, 10% allocation, because as I try to hold a small number of companies, I hold high conviction in almost all of them. So differentiating the conviction from one to another is not that easy.
How much time a month do you spend on investing in your portfolio?
Okay, so since launching the Global Investor newsletter, I spend quite a bit of time on investing, especially writing articles, researching, and trying to read other stuff so I can improve my quality of research. On my portfolio, I don't spend much time. Many days I don't even look at it. I normally go in just to make occasional buys, but I don't get overly obsessed with my portfolio, because I will obviously readjust it after quarterly earnings. If I see something that I don't like, or if I see something that I like a lot, well, I'll buy. But I'm not a guy that stick to the portfolio screen, because I think it's very tiring to be seeing all the time the numbers move, especially when the business is not changing. So I try to spend a small amount of time on my portfolio.
What are your thoughts on Bitcoin as an investment?
This is obviously this is a controversial investment, no? Because you'll find investors that are saying that Bitcoin is like the best investment ever, and others saying that it's going to zero. I personally don't understand it, so that's why I don't hold it. But I have never understood what limits the governments from banning crypto that is not operated by them. For example, I know that they cannot ban that you use crypto to buy something on the internet, but what if they say you cannot pay in crypto in the restaurants? Then Bitcoin will turn to be a store of value, but not a payment system, in my opinion. Like, I've put this question out on Twitter several times, and I have never found a convincing answer to why governments could not ban crypto, especially because governments don't like having things out of their control. And with crypto, I can have a net worth that they don't even know that I have, which is something that obviously is not in their interest. But it could be a very good investment or a bad one. I just don't understand it, so don't hold it. I don't like when people lose money on Bitcoin, and I enjoy if people that hold Bitcoin make money. I just don't want to play that game.
So that's the end of the questions. I guess some more questions about more about your investing philosophy. So we're now moving on to the questions about your portfolio specifically. So your largest holding is an S&P 500 ETF. So could you just talk about your reasoning behind that?
Yes, well, this is basically because when I started investing, all I did was DCA this ETF. So I have been DCAing this ETF for 4 years, and I didn't want to sell it. So now I'm doing all my new allocations of capital are going to individual stocks, but still it was 100% of my portfolio. Now it's around 20%. And that's the reason, nothing more.
So do you expect that to continue to come down over time then? Or do you think there's a minimum proportion that you'd want in index funds?
Well, I have been thinking about this, and I think that having a 30% allocation to ETFs and 70% allocation to individual stocks, it's something that I'm quite comfortable with. So I think I will probably continue allocating to these ETFs on a monthly basis on top of my allocation to individual stocks, because I feel that they anchor my portfolio without, like, they protect my downside without significantly impacting the upside.
Amazon is your largest individual holding. So based on what you said earlier, presumably means it's your highest conviction holding as well. So what is it that you like about it so much? And why don't you think, what would you say to anyone that thinks they've missed the boat on Amazon?
Well, I think many people think that they've missed the boat on FAMF in general, no? Because obviously there are 2 trillion, like nearly 2 trillion companies. They are defying the law of large numbers. I think Amazon still has a long runway to go. If you got it several years before, you would probably ride the e-commerce trend and the start of Amazon Web Services. But I think right now Amazon has been, well, like 1 year mostly flat, going through a difficult period with Bezos stepping down as CEO. They missed sales in the most recent quarter, but segments such as AWS and ads are growing very, very, very fast. Well, some say that AWS is already a 1 trillion company by itself. So these 2 segments is what I'm most interested in. And if you can add, obviously, the e-commerce, the Prime Video, and all of the rest of businesses, I think it has a great future still. I know it's already like 1.6 trillion market cap, but well, it's definitely not the most expensive fund right now. And I don't know. I think it's been consolidating for a long time. And if I'm interested in AWS, well, now the CEO is was the previous CEO of AWS. So I think that transition makes total sense.
How do you feel about DocuSign as an investment, particularly given its quite pricey valuation?
Well, I really like DocuSign. I have written many articles on the company. I think many people don't really understand the company, because when you think on DocuSign, you think on e-signature. But I think that these investors are missing contract life cycle management, which has a long runway ahead. So paperwork for a company, all that has to do with contracts, not specifically now on paper, but well, you understand what you have to do, all the bureaucracy, is a classical job that no company wants to do. So if DocuSign or no company wants to do, no, they have to do it, but no company wants to invest in significant resources for that matter. So if DocuSign is able to find traction on the CLM offering, I think it should maintain its growth for many years, even if e-signature is still growing fast, where they are the complete leaders because they have 70% and Adobe has like 20% and the rest has 10%. This combination, I think it's perfect, because with e-signature, which is something that most businesses want to have already now, like in 2020, 2021, they get the customer and then they can cross-sell the CLM and everything integrates. So I think that they are still growing very fast. The CEO, Dan Springer, is, for me, he's a visionary. And CLM is so early into the story that I don't have really a comment on valuation, because obviously if you take what it's known today, it's richly valued. It has run up very fast, the stock price, especially since the last earnings. But in 5 to 10 years, if CLM gains traction, I think obviously it's not overvalued at all today. It's obviously there's more risk because you are, I don't know, you base your decision on a product that is still very early into its innings, but I think this is how you make money in the stock market. If you bought Facebook, well, Facebook, I think, just became public just after buying Instagram. Well, but if you bought Facebook at IPO after they had bought Instagram for 1 billion, you are probably thought, whoa, they overpaid for Instagram. Instagram was like a zero revenue business. But if you trusted Zuckerberg's ability to turn Instagram into what it has turned today, then you made a lot of money. If you didn't trust them and you said, oh, with the information I have today, Instagram is not worth anything, well, you don't invest and you don't make the money. My investment horizon is 5 to 10 years minimum. So I think I have time to let the company figure out how to play CLM. And I think it's going to start playing out quite soon.
What do you like about Unity as an investment? I know you touched on it earlier and you said that it's more than a gaming company. So could you expand on that a little bit as well?
Yes. As I said earlier, I wanted to have exposure to the gaming industry. And well, it wasn't me who chose Unity as the next deep dive. I did a poll on Twitter and the people chose Unity. I did my research on it, and then I saw that it was much more than just gaming. Unity is very well known for its engine, that it's like the create solutions segment of the company. Its game engine were like especially oriented to mobile games, which is the fastest growing segment in the gaming industry. And then I saw all the operate solutions, for example, that is like the media segment, the ad segment of the company. And also, I think it's one of the companies that I hold with the largest optionality, because they are probably number one in AR, VR. and they are already working with other industries. And I think AR/VR is applicable to almost any industry in the world. So I think I was not gaining exposure only to the gaming industry, but also to AR/VR, which is growing very fast. Well, you just have to look 2 weeks back where the metaverse was in the mouth of all the big tech CEOs.
What attracted you to Howard Hughes Corp? Because looking down the list of your portfolio, it seems very different to a lot of your other holdings.
Yes, this is my real estate play. I think real estate is it's an industry that has to solve many problems, because obviously there's the ethical questions of affordable housing and how the housing costs are increasing. And I can see this, for example, here in Spain, in Madrid. Okay, you can have the situation where you are in an internship and they are paying you 600 euros a month, and to live, your rent is 600 euros a month. So obviously you need like the help from your parents if you want to take that offer. And housing costs keep skyrocketing while salaries are not skyrocketing. You could also argue that I have kind of real estate exposure with Airbnb, but well, this is pure real estate. So I like the idea of master plan communities, which are MPCs, that Howard Hughes Corp does. Well, this is basically that they create a portion of land and they make like a community. They sell the houses, the commercials and everything. So up to I bought it basically as a COVID recovery play, and up to now it's been quite good, to be honest. But if I had to, I have a very small position on a cost basis to the company. So it's obviously one of the stocks that I hold with the least conviction, and not because it's a bad company, just because I don't know it as well as my other holdings. So if I had to cut off any position, this would be one of them. Although I would be like committing a sin, an investment sin, because I would be selling a winner. But I don't know. I want to hold a portfolio with which I'm comfortable with, and if this company in the future, I don't feel that I have a good understanding of it, or I cannot keep up with how it's evolving, I'll just sell it regardless of the percentage gain or loss.
How did Howard Hughes Corp come across your radar? Do you remember?
Yes, there's a Spanish Twitter account, and he was sharing content on Howard Hughes Corp, and then I saw it's a Spanish thread. A Spanish account did a thread on MPCs, on master plan communities, and I was very interested in the thread because it was like science fiction, like building artificial cities. But then when you saw them, they actually were very they were very nice, full of people. It's not like an artificial city in the middle of nowhere. So that got me interested, and I started looking at it, knowing that obviously master plan communities are like the most long-term investment you can probably have, because you basically have to build a city from scratch.
You hold Alibaba and JD. How do you feel about their valuations and the risks facing investors in Chinese companies?
Well, I think I started gaining interest in Chinese companies since meeting Buy and Hold, with which I collaborate in the newsletter. My thoughts here are pretty simple. So China is a huge market, probably one of the largest TAMs in the world, growing very fast. So I also wanted to have exposure to it, but I didn't want to do it in a way that I went in without understanding the risks. So I was talking to Buy and Hold, and well, obviously China doesn't have a conventional government. So this is why I decided to allocate a maximum of 5% directly to Chinese companies. I think currently Well, after today, it's going to be more, but I think it's currently 2% of my portfolio, combined JD and Alibaba. And I'm very well aware of the risks, but I honestly can't understand how someone can say, I'll hold 2% allocation to crypto, even if I don't understand it, and it's very risky, because if it plays out, it's going to be massive. Well, for me, this is exactly the same case. Even safer, because it's a company that you have behind this investment, and that's the reason I decided to invest. I also think that the Chinese government does not have an interest on destroying its large companies. They know that they're going to be key to be the #1 economic country in the world. They are not stupid.
How has buy and hold influenced your thinking towards Chinese companies, if at all?
Well, you see a lot of things on FinTwit, right? Like, hey, look at the communist government. They are destroying everything. They are going to take your shares. This is, for me, this is a bit clickbait because most of the times these comments come from people that actually don't know the situation in China, or haven't spoken even to a local. And I know buy and hold has a lot of knowledge in China, because he speaks almost daily with locals, and he knows how everything is really going. For example, the last movements by the government was something that was laid out previously, but it was just they did it now, but it wasn't anything that wasn't known. So I think that he has helped me see that when it comes to China, you really have to know whom to speak with, because there are many people who say that they know a lot about China, but really they don't, because you have to really speak to locals there to know what's going on.
How do you feel about Palantir as an investment? And like DocuSign, that's another one where the valuation, you've definitely got to pay up for it.
Palantir, I think, has a product that will be used by almost every company in the future, because I think they have a nice flywheel going. So they launched Foundry. I don't know, I did a deep dive on Palantir. I don't remember exactly the number, but 6-7 years ago, or 7 or something like that. And the average contract period has been 6.6 years, which means that the companies never leave Foundry. This evidences that the product has high switching costs, and as they sell the product to more companies, they are able to improve it, because they are getting more data, and they are also facing more individual situations. Because how Palantir works is that they go to a company and they say, okay, where do you want Foundry? Okay, we'll install the software here, but we'll be alongside you for X weeks, and we'll tell you and you'll tell us what you need from Foundry, and we'll try to personalize it as much as we can. So that is actually helping. They do this with forward deployed employees. And this is why one of the main criticisms of Palantir, that many people see it as a consulting business. And once they have all these situations and they have tailored Foundry to a lot of customers, Foundry is getting better, because it's able to solve a lot of more problems every time that they sell it to a new customer. Once they are, and now they are working on modularity of Foundry, so that if you are a company that wants these 3 modules and I don't want those 2, well, you can tailor Foundry to your needs, which is also going to help them go down market, because obviously Palantir has a product that is very oriented towards bigger companies, because they are the companies with the biggest amounts of data, and data is the new oil. So everyone is going to have vast amounts of data in the future, and probably they will need Palantir, because building this product in-house is very, very expensive. And you don't, and it's not only an upfront expense, it's an ongoing expense because you have to keep updating the product, and Palantir is doing that for you. So I think it has a great product with high switching costs. Obviously, not a cheap stock, especially if you factor in the massive stock dilution. If you take into account that Alex Karp in, I don't know if it's 2019 or 2020, he made 1 billion, which is kind of crazy. But to be fair, Palantir has been a lot of years with almost zero revenue, just working for the government. So now they are rolling out to commercial customers and it's going great. So I think it's definitely not cheap, but for me, it's one of the companies of the future. If Palantir in 10 years is 1 trillion, I wouldn't be surprised because probably all of the 3, 4, 5 trillion companies have Palantir's product.
So that's the end of the questions. So firstly, thank you very much for coming on the show, and thank you for doing it in your second language. If I'd had to do the interview in Spanish, it wouldn't have gone nearly as smoothly.
We have to try that too.
That would be quite messy. I think the audience might struggle as well, actually. I don't think we have many listeners from Spain either. So where can people go then if they want to find out more about you? And also, how can they subscribe to the newsletter?
Okay, well, the main point of contact with me is the Twitter account, which is @Invesquotes. And they can also find information about me and of our articles in our newsletter, which they can subscribe if they go to my Twitter account. It's linked in the profile. And yeah, that's basically it.
Okay, well, thank you very much for coming on the show. Thank you everyone for listening. We'll see you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.